The inverted yield curve, widely seen as a reliable recession predictor, reared its ugly head last week, triggering an 800-point drop in the stock market. So is the bond market signaling a coming recession? Joining me is Scott Colbourne. He is Managing Director at TD Asset Management, here to explain everything to us. Nice to see you.
Good to see you.
How's that for a big ask? Explain everything to us.
Yield curve?
Yeah. Well, let's start, because that's the one thing I think that people jump over, and we hear, it's now in cocktail conversations, let's say, about inverted yield curves. Can you explain why people get so concerned about an inverted yield curve?
Yeah, I mean, simply the yield curve is the difference between short-term rates and long-term rates. And you look back in history, and long-term rates are higher than short-term rates, and that's the normal. You would expect to be compensated for, lending money longer. You want more compensation for taking that risk. Mm-hmm. Over time, and there have been a handful of times in history, the yield curve inverts. That is, long-term rates go below short-term rates, and that's a signal, broadly speaking, that monetary policy is too tight. People are looking for long duration assets. They're looking for risk-off assets, government long bonds, and what we're looking for is the central banks to adjust to that. And it's a fairly reliable long-term indicator of future economic activity. Mm-hmm. So that's why we have to pay attention to it.
Well, I was going to say this. I was joking with you beforehand that I've heard different jokes, but the inverted yield curve has predicted 10 of the last 7 recessions.
Yeah, it's not infallible.
Yeah. So, but that's just it. But it has. The real question here is, it says 7 of the last 7 recessions. Yeah. So is it that important? Like, is it something that never goes wrong?
Nothing ever goes, nothing's perfect in the financial markets. It's a very good indicator. We have to pay attention. It's part of your toolkit.
Yeah.
Is it infallible? No. It missed a couple and missed in the 60s. There are distortions, as Beata talked about earlier. There are influences on the yield curve that, may put a question mark here.
And what are those, just so people understand? Because she mentioned financial markets, so there's like the real world and there's the financial markets. What could distort it?
Well, the biggest influence since the financial crisis has been quantitative easing and negative interest rate policies as well. So that influence of central banks buying assets and forcing investors outside of government bonds elsewhere, and so it's a real distorting impact on investors' behavior. And now we've got about a third of the global bond market with negative yields, and that search for long duration assets that have a positive yield is a distortion. That pension funds, insurance companies are looking for those long dated assets to match their liabilities, and they're not getting them in Germany, they're not getting them in Japan. So you're seeing that demand, and that's a distortion. There's regulatory distortions as well, where it creates an artificial demand for safe assets like government bonds. So those, it's something we should note, but I don't think we have to ignore the yield curve. It is an important one, and then you combine it with other indicators, real asset indicators, the real economy.
Which some of them are starting to slow down a little bit, which was what we're saying.
Yeah.
Let's take a look at a chart here. We've got one up. I think we can show some of the yield differentials. And what I want to also ask you is that different parts of the curve can be inverted. So what does that mean?
Now you delve into the arcane of the yield curve, and different parts of the market focus on different things. We talked about 2s, 10s, 2 years versus 10-year rates last week that caught the attention of the market. The preferred indicator of policymakers, the Fed, the Bank of Canada, is 3-month rates versus 10-year rates. And by the way, that's been inverted since May. So, why all of a sudden the attention last week? Because parts of the yield curve have been inverted, and the one that actually policymakers focus on the most. And when you look at that 3-month versus 10-year globally, most global yield curves, developed market curves, are inverted. So it's not really new news, but it is,
it's an 800-point market.
Yeah, it shocked the market. You throw in all the trade tensions and all and the real economy slowing. So you have to pay attention to all those indicators. But it's focusing exclusively on which part of the curve it gives you that best indicator, and using that combination of the financial and the real economy, I would say that the likelihood of a recession is maybe 30% next year and maybe 50% over the course of the 2 years.
Right, because that's the one thing I know you've mentioned too. The inverted yield curve tells you what could happen, but doesn't tell you when.
No.
Right.
Yeah, there's long legs.
Well, let me ask you too, in terms of other data you're watching, you mentioned other real economy indicators, like what? Like what are you watching right now?
Well, the jobs market is so key. It's the other
Yep.
part of the Fed's mandate, inflation and jobs. And the high frequency part of the job market is the jobless claims. And that's proven to be a very good indicator as the jobless claims market increases, the U.S. jobless claims market. If that starts to increase, that's an indicator that the U.S. jobs market is slowing down. So that's something I pay attention to. The housing market. Typically, that's been a very important indicator over time for the health of the consumer. And the jobs market is okay. The housing market is okay in the U.S. And so, those indicators right now would say, have a lower handicap in terms of what the outlook for a recession is next year or two.
I've only got about 20 seconds here, but I am going to ask you just why do people hold bonds in times like this?
It's always a diversification asset, right? Yeah. You have to hold it. It's proven its mettle as a diversification asset. But there are opportunities. High yield emerging market, if things get cheaper, you got to buy those as well when things get cheaper.